It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. This is Managing Your Financial Future. Oh, am I excited today. This is good. Normally, if it's just Professor Plum with me, you know, it's not
get excited at all.
It's not that big a deal. I joke. I kid because I love. But no, I'm happy. I have Professor Rick. I have you here, Professor.
I'm here, yes.
Yes. I'm Johnny Dean, your podcast host, not the advisor. But not only do I have you, Professor Plum.
Yes, you have me.
Certified financial planner, the CFP professional, however you're supposed to say it. I've got Joe Accardi, who has joined us. Joe flew all the way in from Boston.
Well, from Western Mass.
Well, but
no,
it's
from Logan Airport.
Oh, okay.
From Logan Airport.
Well, you flew in from Logan, yes.
It's right across the bay.
I grew up in Cambridge, man.
Okay, there you go. He flew in from Logan, right across the water from Winthrop, Massachusetts, which I know very well.
In East Boston,
That's
yes,
right.
exactly.
I've got all kinds of in-laws that were all spread all over the place.
Any outlaws?
And the outlaws were in. They
are the deans.
Abington. The in-laws were in Winthrop. Anyway, Joe Accardi. Joe is the chairman and founder, if I said that right, of Accardi, the Accardi Financial Group, and you're based actually in
Western Massachusetts.
Based in
a town called Wilbraham, the home of Friendly's Ice Cream.
Is that right?
Good stuff.
Friendly's?
Friendly's Ice Cream.
That's their home?
That's their home base.
Ooh.
A mile away from the office.
Every time we go back there, somebody has to tell us, got to go over to Friendly's over there. We're going to stop by Friendly's after dinner, after supper. So anyway, Joe, thank you for being here.
You're welcome. Pleasure.
Yes. You've got your own financial planning business that you've been, you've been in the business a long time. I wanted to bring you on today, number one, because we don't have you here with us in Southern California where we're based. So
unfortunately.
I will grab you if I can and have you talk with us today. We're going to get into a buckets discussion because I know you've been doing buckets for many, many years with your clients, and it just happened that we all kind of
got together
a number of years ago, and you guys with Professor Plum and work with some of our advisors. It just we have a nice relationship going here, so that's why I wanted to have you on, and I wanted to have a discussion on this. But if you would, Joe, tell me how you got into this whole business. You've been doing this for a long time.
Yes, fortunately or unfortunately, I have.
When did it start?
So I graduated from Bentley College or Bentley University in 1972, 73. I was like a November graduate class. And my first job was with Dun & Bradstreet, and I was a cold caller.
Cold caller?
We don't hear about that much anymore.
No. So I would walk into businesses, an industrial park, and call on every business and try to get in to see who's ever in charge of making the purchase.
You were actually walking up and knocking on doors.
Knocking on doors, man.
Just go through a business park and walk door to door.
Exactly.
Wow.
And hope to get in to see one or two people for the day.
And how long did you do that for?
Did that for about 6 to 7 years.
Wow.
Oh, wow.
Right out of college.
Right out of college. That was my thing. I was actually okay with that.
Yeah. Well, hey,
I was comfortable.
You're young, right?
Exactly.
You got the energy.
Those were the days.
They were. You don't see that a whole lot. So that led to what?
So I was actually cold calling in Springfield, Massachusetts, and I cold called a company called Merrill Lynch.
A little company.
I wasn't really sure what they did, but I was cold calling them to see if I could sell the services. Then I realized they were a wealth management firm,
yes.
Obviously, one of the biggest. And I got through to the president of that local division, if you will, for Merrill Lynch. And halfway through the interview, he asked if I'd like to work there. So
he figured you got that far in a cold call. If you could do that for the company you were working for, you could do it for them.
So he was impressed with you, obviously.
Obviously, yeah. And so I was impressed with that myself, that he actually wanted to hire me.
So what did he want to hire you for?
He wanted me to be, an investment guy, a stock and bond guy, a representative,
sure.
if you will.
Okay. All right. So you started that when?
So So I started that, actually I got hired in around the middle of 1978 and got licensed by 1980.
Okay.
Fully Series 7 and all the additional licenses, that I needed.
And so you were your main job at Merrill was to do just brokerage type stuff?
Brokerage type. Back then it was buying and selling of stocks.
Right. Okay.
Not even mutual funds, sometimes mutual funds, but in fact they had a gallery, the bullpen they used to call it, and there was a big TV screen. Back then I think it was like 20 inches.
That was a big TV screen?
No, they actually had a ticker tape.
Of course.
And there was a gallery seating for about 20 or 30 investors. And back then the investors would come in, the ones that like to trade, and they would sit in those seats. They'd watch the ticker tape, and then they'd run to their broker in the next room and say, I want to buy 100 shares of IBM, or I want to sell. And that's how we did business back then.
That was a good portion of the 80s, which to me doesn't seem that long ago, but we're talking 40-something years ago now.
Absolutely.
So how long did you do that? I mean, obviously you started your own business, but how long were you doing that before you started your business, and what got you into starting your own business?
Yeah, so I found that I really didn't want to be a stock trader. I didn't want to do that. I didn't want to do all the research myself. I didn't want to kind of build my practice on that kind of way of doing business, if you will. I wanted to do like financial planning.
And that was fairly new at that point.
It was new, but it was around, and there were several programs had developed, and there were some businesses that trained you on how to do financial planning. And I ended up being with a small company that did only financial planning for clients, FFP Securities. Guy by the name of Roy Henry, who's now passed away. I was on a plane with him, and he gave me the pitch, and I thought it was interesting, so I went for an interview.
Well, so you saw some value in financial planning, because I know at that point, I mean, the 80s were okay for stocks, but you saw the 87 crash.
Yes.
Which I think may have hurt a lot of people.
Yeah, you build wealth for 7 years in that case, and then half of it disappears overnight.
Yeah.
Which you never forget. It's embedded in your brain forever.
So I would imagine that played a role in you thinking about, well, what about helping people plan?
There's got to be a better way to do this.
So you started your business at what point?
1990, January, February of 1990.
And this is where the Accardi Financial Group came into existence.
Yes, in Wilbraham, Mass.
Yeah.
Yep, right down the road from Friendly's Ice Cream headquarters.
Oh, yeah.
That's really
the home
incredible.
of Friendly's Ice Cream.
And you've been doing this ever since then. You've been overseeing this business since 1990.
Exactly.
You've grown it, you've nurtured it, and you've learned some things along the way, I would imagine. I know we'll get into your son and daughter eventually joined your company.
Yes.
And they're still with you now, kind of acting as the CEO and the president, or whatever their particular titles are.
Exactly.
When you first started in doing the financial planning, had you ever heard of buckets as a type of as a withdrawal strategy, or what philosophies did you use back then with your clients?
So back in 1990, the business was really still transactional.
Yes.
People were buying and selling. After the crash, mutual funds became much more popular to diversify portfolios.
Mm-hmm.
And but it was still transactional in 1990.
What does that mean? Like financial planning was transactional. What does that mean?
You'd buy a mutual, you'd pick a mutual fund and buy it.
It was commission-based.
Commission-based.
Okay.
Transaction-based.
Mm-hmm.
Then down the road, someone would buy a couple of stocks, and halfway through the year, they say, I want to sell these. What do you think? And you'd be still transactional, suggesting whether they should buy or sell whatever they had to make more money.
It sounds similar to what you might have been doing at Merrill, but now you're working with individual clients and families and things like that. Is that right?
Yeah, it's exactly what I was doing back then at Merrill, but in a different way. So I needed to, I didn't have Merrill Lynch behind me at that point, and so I needed to do something that was more secure for my clients. So I started to delve into financial planning programs and schools that taught financial planning. And that's how I started, really.
So now, Professor Plum, you were in the business at that time as well.
By the 90s, I was. I started in the. I got started in the business just before the crash.
Right.
And so
in '87,
losing half of my wealth didn't matter at that point because I didn't have any.
Half of $5 is about $250.
If I had five.
Yeah, exactly.
So, and I got into financial planning, and things were a little. There was financial planning softwares that created these 200-page, mostly boilerplate, and it was. But financial planning was mostly around risk management, and one of the biggest risks is losing money. You know, in the stock market, when it comes to the investing standpoint, losing money is a bigger risk than maybe missing out on the super high return.
Yeah. Well, Joe, you I'm sure recognize that even back in 1990 when you first started your practice. What sort of things did you do for your clients at that time? I mean, the business has obviously changed over the last 30 plus years. But what sort of risk management did you use then, and how did this eventually transition into buckets, which I really look at as a total risk management type of.
Absolutely.
Yeah.
So how did you evolve into looking at something like buckets, and how did it become your primary focus?
So back in 1990, as Professor Plum just said, there were computer programs that generated these 20 and 30-page financial plans. And the problem with them, and I think still exists today with many plans, is their projections of what you might do. There's no really practicality to all 20 or 40 pages in there.
Yeah.
In fact,
there's a lot of boilerplate in there.
A lot of boilerplate that was just generated by the computer, and most of it couldn't be applied to your plan because there was too much involved. There was too much detail in the plan.
Okay.
So I knew there had to be a better way to do this, and of course that was back in 1990. I went through the crash of 1987. You build the wealth up again from 1987 until the year 2000 for the tech crash. And then half of your wealth is taken away again.
Oh, that was devastating.
And now you have to explain to your clients, well, I had no control of this, and obviously no one's happy. And then, 2008 happens, and the entire world is devastated. Because even if you were diversified and you had stocks and bonds, both of them got hit.
Oh, you
lost more than 50% because it was devastating to everyone.
2008 was as close to 1929 as I think we ever wanted to get.
Exactly.
Yeah.
And now people, and personally as an advisor that looks to help people, you really don't feel like you're helping people. So I was on this search for how can I help my clients. That's what got me looking at something different.
So your task that you set for yourself was, I don't like going back to my clients and saying, I'm really sorry. Obviously, it's out of my control, but, you were about to retire. You may not
be able to.
You may want to rethink this. And this was kind of getting to you?
Yeah. Personally, it bothered me because it wasn't, my money was affected as well, but I was worried about my clients' money. That's my responsibility.
Oh,
right?
Sure. Nobody wants to sit there and say, I know we talked about you retiring at the end of this year, but...
Sorry.
Yeah. And that's one of the things that Professor Plum that we've talked about with buckets as well.
Many times.
We do not want the markets to dictate what our lifestyle is going to be, right?
We want you to take control, we want you to be in control of the big decisions. Big decision being, when do I retire and how much am I going to be able to retire on? And we don't want the market dictating when you can retire or how much you can have based on what happened in the market. We never want to be in a position where the market dictates our financial life.
Yes, and Joe, you saw this happening. You saw it, as a broker before in 87, but you saw it when the tech bubble burst in 2000, and you saw it again in 2008. So let's talk for just a second. Professor Plum and I have talked about buckets quite a bit, and how it is it is a risk management type strategy. Explain to people who may have been listening for the first time, how do you explain to people how buckets works and how it is a risk management tool?
So I ended up reading this book called Buckets of Money that was written, and it intrigued me to find out who wrote the book and the basis for it and the academic research. So for me, remember, now I'm by myself, I don't have Merrill Lynch behind me.
Yep.
I wanted to rely upon academic research. Buckets of Money is academic research. It was designed because of academic research to back up bucket strategy.
The smart people, the PhDs or whatever they are.
Yes.
I think the author called them propeller heads.
The propeller heads.
The propeller heads.
Exactly.
Well, that is kind of what it was. So you read up about this. Now, if I came to you and said, I don't understand, what is buckets? How would you explain that to me?
It's really easy. It's a way to categorize your money so that you can create income. Pretty simple.
So how do I?
So it's a 3-bucket system. There's a bucket for income now, a bucket for income later, and then there's a long-term growth bucket.
For income way down the line.
Way down the line, but way down the line. And we use 15-year, in the strategy, 15-year periods because of their performance.
Yeah.
Is what we project in the illustrations.
And so how this helps people, I think, for me, the light bulb kind of went off when I thought, well, I still don't understand, because if I have money, obviously I have money still in the stock market, and I can't control that. The money goes up, the value goes down when it's just cyclical. Well, what you were just saying was that we've talked about here is that you have to take a chunk of money out of the markets, correct?
Correct.
And you have to have that shielded from the volatility of the stock market.
And that's about 2/3 of your money.
When you get down to the first and the second buckets, correct? How do people, when you explain that to them, do people tell you, well, wait, so you're only investing 1/3 of my money? Does this upset people, or does this give them the reassurance that they need?
Actually, after you present the bucket strategy and the 3-bucket system and the 5 categories, people just open up to you and say, this is what we've been trying to do our whole life. We don't know how to do it. And then they want more detail. How does it work? And we go through a complete, we call it a yellow pad or a whiteboard to demonstrate how the system works with their dollars. All we need to know is your dollars, where you are in retirement, what your goals are, what your risk level is, and what your time horizon is. And by doing that, we can now categorize into the particular buckets.
Yeah, and for you, you've seen what we've called a systematic withdrawal method as well.
Yes.
And we've talked about this, Professor Plum. Explain how that works.
Well, the systematic withdrawal is just basically using one portfolio, usually 60-40, 50-50 stock bond mix. And it's kind of what people use to accumulate wealth. When they're saving for money, they're putting it into their portfolio. And they just put it in, and they keep the balance, between large, small, mid cap, international, domestic. And as they get closer to retirement, they start tempering the volatility of the stock market by adding bonds. But they have that mix. It's one portfolio, and they just have a mix. And they change the stock bond mix, and they get a little bit more conservative as they get close to retirement. And then when they retire, instead of adding money to the portfolio every month, every week, however often they're paid, they start taking money out of the portfolio.
So they do the reverse of what they've been doing for all those years.
On the way in, you're getting the advantage of the dollar cost averaging. On the way out, now you're doing reverse dollar cost averaging, which means you're still subjected to the ups and downs. Now, they may not be the extreme ups and downs of a pure stock market portfolio, but like Joe said, in 2000, we saw everything go down a little bit. In 2008, both stocks and bonds went down a little bit or a lot. And so when I'm pulling money out of it, I'm selling at a loss position. I'm selling when things are down. And that's the worst way to take a cash flow from a portfolio, is to have to sell something
It's
when
not
it's
the
down.
second best. It's the worst way to take money from your portfolio.
It's horrible. It's just, you're shooting
right.
yourself in the foot, because you have to sell so many shares, and those shares can never recover.
Because you've sold them.
You sold them. You don't have them anymore.
They're gone.
Yeah.
And so we were looking, when we first started doing buckets, how do we avoid having this pro rata distribution, systematic withdrawal, and subjecting ourselves to the ups and downs of the market, even if it is tempered a little bit from a pure stock market play? How do we avoid having to sell when the market's at a loss? And whether bond or stock market, you take your poison. And the only way to do that was to have cash on the sidelines that we could draw down, principal and interest, to buy enough time to allow the more volatile areas to go through the shenanigans that the markets do from time to time and recover.
Yeah. Now, Joe, you've seen, and as we've seen too, or Professor Plum has seen, different versions of buckets. I've seen it where somebody says, well, let's give you 2 years worth of cash investments, and then we'll just invest the rest. Have you seen these different iterations of buckets, and what's your opinion of that?
I have. So of course, I came from the wirehouse Merrill Lynch, and I believe today even they talk about buckets of money today because it's the term to talk about.
Yes.
They're really referring to just reverse dollar cost averaging, and they consider buckets asset allocation buckets. Right, Rick?
Right.
They're thinking about, one bucket's going to have 40% bonds, and the other's going to have 60% stock, and that's going to, protect you in the future. And then you have to reverse dollar cost average, take the money out when the market's down. And once again, not to, reiterate what you said, but it's the absolute worst way you can take money from the portfolio. But that's what's being pushed, I believe, by the big firms. It's simple for them to do.
Oh, it's so easy.
Look they set up one portfolio. You come in and do a financial plan. They give you one of those 40-page plans that looks great, but it's a projection. It doesn't tell you what the market's going to be doing because they don't know.
Right.
It's not telling you how you're going to be able to get your income because they don't know.
Wow.
Right? So I make you believe that you can relax about your portfolio because you're no better off. Even if you hadn't done that, you'd be better, in my opinion.
Well, I've seen them also use, this portfolio has averaged 8.5% over the last 20 years. So it'd be easy to take X amount of dollars out. You'd be fine because it's doing it. It has averaged, but a buy and hold 8% average rate of return is very different than using that same portfolio on a distribution pattern because you're not going to get 8% when you start taking money out of it. Buy and hold averages, and that's what they talk about, is one thing. A distribution average is completely different, and it's much lower.
Well, it is, and we've done these different. I don't want to call them studies, although I guess they are studies that show that in certain periods of time, that systematic withdrawal method, if the markets just go up for 10 to 12 years, then you're probably going to wind up with.
Right. It's all about what happens.
Can work.
Yeah, it's all about what happens in basically the first 10 years.
Sequence of returns.
The sequence of returns. If you have a positive sequence of returns over the first 10 years, but can you tell me what the sequence is going to be for the next 10 years?
Yeah.
Nobody can tell you that. Anybody that says they can, you need to run away from. So it's all about what happens in the next 10 years, whether or not you're going to be able to, have a comfortable, easier going, retirement potential than running out of money. Because if you have a couple, and they don't even have to be big down years, you have a -2, a -5, a -6 over a year, you start dipping into principal. And once you start really dipping into the overall principal of the portfolio, you run into trouble.
And that's the problem with a straight line financial plan projection.
Exactly. They all say it comes to two things. You can average this. Markets don't do the average. They go up and down a lot more, and then over time they average. And they also, the other thing, I don't know if you've noticed it, they input inflation into it. And maybe it's a 3% inflation factor. And they increase the need by that inflation factor every year until you're 110 years old.
So in other words, if I need 60,000 a year today, I'll need 62,000 next year. I'll need 65, whatever it is.
By the time you're 100, you're spending like $14 million a year.
Right.
Which
and
doesn't
your
happen.
portfolio's worth $1 million.
Yeah, and the reality is people don't spend money like that.
Especially as they get older.
Right. I mean, maybe in the when they're in their 60s and they're doing more things, inflation hits them a little bit more. But as they get into their 70s and 80s, the amount of money they're taking out of their portfolio starts to become more flat. Where sure the inflation is happening, they're spending more on the items they're buying. They're just not buying as many items. So those projections that you were talking about, Joe, they go out forever, and a small change in any one of the variables has a dramatic impact on the ending result.
Like inflation being over 8% right now.
Yeah.
Yeah, I mean,
on 1 or 2 years.
Well, we talked about 2000, we talked about 2008, and what if somebody were retiring right around that time, and you would have had to give them the news that, back then, well, you may have to hold off for a year or longer.
Yeah, instead of taking 4% from your portfolio, sorry, you have to take 8%. And if things stay the same in the marketplace in about 12 years, sorry, you have no more money.
Yeah, and that's the worst part of it. So,
in 2000, you started a 4% withdrawal. 2001, you're taking an 8% withdrawal. 2002, you're taking a 16% withdrawal.
It's gone.
There's no recovery.
There's no recovery.
Because we had 3 bad years.
Because that's
really bad
that's
years.
very bad sequence of returns.
That was
Exactly.
horrendous.
Extremely bad.
Exactly. And now, why are you you're still taking the same amount of money, but the problem is, $5,000 a year out of a $100,000 portfolio.
That's 5%.
But if it's $5,000 out of a $50,000
Now it's
portfolio,
10%.
now you're at 10%.
And then if it's 5,000 out of a 25,000 portfolio.
well, forget it. You better go back and find a
Sequence
job.
of returns dictates your financial stability.
Yeah.
And you are not in control of that sequence.
Ever.
No,
Ever.
you're not. And we've talked about this for people. There are people who I'm sure retired. I know there were people who retired at the end of last year. And doggone it, that was a good year. Their portfolio was up, right? And they have seen what's happened so far, at least in 2022. We've had interest rate increases over and over, a couple of 75 point, and that did a number on stocks.
And that's happening today again, I believe.
It is.
Today is the day.
Yes, it is. The day we're recording, they just raised it another 75 basis points, which, can rattle stocks early on. But at least this way, you don't have to talk to a client and say, you
Sorry.
retired, but you may want to check the one ads.
You may have to go back to work because now you can take half of what you expected to take. And by the way, I don't think you can live on that because I know what your liabilities are.
Yes, and if somebody were just taking money directly at selling stocks to pay their bills this month, taking a what we call reverse dollar
Or
cost
even from
averaging,
a balanced portfolio.
or even from a stock bond portfolio,
Right.
Because bonds, heck, raising interest rates.
That's not good for existing bonds.
No.
No.
Bond values go down.
That's exactly what they do. So with buckets, to tie this all in, with buckets, Joe, you see that as kind of as a saving for some people potentially?
Because in reality, when we do these bucket strategies for clients, most of them are comfortable with about 30% of the money in bucket 3.
Mm-hmm. That's their their
long-term
equity
growth.
Yeah.
Right. So if the market goes down by 50% temporarily, they have 300,000 in that bucket, and 150. It's down to 150. It still doesn't affect their income. Their income is there. It's some of it's guaranteed.
Yep.
Right.
Yep.
And they don't have to worry about adjusting their income according to the market.
So over your years of experience, Joe, have you seen what Professor Plum has seen, which is that as long as a retiree has their income needs covered, regardless of what the market is doing, then they're happy generally.
Generally.
Do you see people still getting nervous, even though they don't need this stock market money for 10, 12, 15 years?
Actually, I have a very good friend that's close to my office in the same business, and they use the 60-40 model.
The 60-40 mix of stocks
mix of
and bonds.
Systematic withdrawal.
Systematic, reverse dollar cost averaging.
Yeah.
And every time we see them, they say the phone is ringing off the hook. And literally,
Not in a good way.
literally, I don't know that we've had one call about the market. Literally.
Yeah, simply because they know that they've...
Look, when you develop a strategy, a bucket strategy, you get it bound, and it's in your hands. You can refer to your strategy anytime you want.
Yes.
And then if you have questions, you call us up, and we're able to go over the strategy again and reiterate everything.
Well, it's a psychological thing, and I know, Professor, we've talked about this.
Oh, yeah.
Where
When you've got the strategy, you know your cash flow is set. Yeah, you're not real happy when you open your statement and you see your 300,000 that went down to 180 or whatever the number is. But you also know, okay, now might be a really good time to invest. I don't want to sell that. I've got 12 years. It's going to recover at some point. We just don't know whether it's a quick recovery like we saw in 2020. Well, we know it's not going to be that quick. Or is it going to be a more prolonged recovery like the 2000 to 2010 time horizon where it took 10 years for the S&P to reach back where it was before. But you've got the time, and so you tend to be less reactive. You tend to be less likely to sell out when it's down just because you're afraid of it.
And more willing to value average.
Yeah, and when the markets are going great, like they had been up until this year,
right?
It's like, okay, we're way ahead of where what was the S&P was up 29% last year.
Yeah,
it's like that's a lot more than we really expected. I don't know what's going to happen next year, but maybe we take a little cream off the top. and backfill bucket number one a little bit more.
Buy you another
Buy some more
year,
time.
whatever. Yeah.
Buy more
Buy
time.
time.
Buy time for the markets to become irrational again.
Do they ever call up and say, now I know I'm not supposed to be worried, but remind me why I'm not supposed to be worried?
We get that from time to time.
Yeah.
And you say, yeah, remember we talked about this and this, boom, boom, go back over the show. Oh yeah. See, that's exactly why I call you, Rick. I'm going to go golf. Bye.
Do you ever play psychologist?
Yeah,
sometimes?
actually, that's a big part of our job, right? We have to help people through the rough times, and if the impact of the stock market affects them so badly, they need to talk to us, and then we review the bucket strategy. And now you don't get a call for a long time, even if the markets plummet for long periods of time.
Yeah, and that's a wonderful way to look at it. You know, you have people who are in the middle of a company with layoffs going on around them, but if they've got I don't want to make this analogy too much, but if they got like a contract where they're going to get paid no matter what, they're far less concerned about the chaos going around them. And I think when somebody's got a retiree in particular has their income guaranteed, as we said, with all the chaos of the markets going on around them, if it's not really affecting them.
Yeah. So the bucket strategy blocks out the noise.
Yeah.
That's what it does.
That's the design. That's what it does by design.
It's a risk management, idea that the whole idea is, can you sustain the cash flow that you wanted?
Yeah.
Regardless of what the market does tomorrow, because we don't know what the market's going to do tomorrow.
So in reality, people say they don't mind the stock market and the volatility of the stock market, and you have a 12-year run, which we just had, of positive returns.
Sure.
Everybody wants to be in the market. The day the market pulls back 10% or 15%, no one wants to be in the market, and that's why you have sell-offs. Because the emotion drives the decision. We help people because we take the emotion out of it by having a strategy in place.
Boy, that's where have we heard that before?
Well, it also reminds me of all those studies that are done year after year after year. They do studies on the different segments of the market, what they return, what they average return over a period of time, and the individual investor in the market. And the individual investor dramatically underperforms the market.
Yeah.
Because they want to get in. I mean, we had people wanting to get in, go more in last, November, December. They were all happy about investing in the market last November, December.
At the top of the market.
When it was at near all-time highs. And if you tried to talk to them about investing in the market, if they had some cash on the sidelines, it's like, are you insane? It's like, well, it's on sale.
It's exactly it. Yes. But it's hard for people psychologically to look at that.
Because money's emotional.
Very.
Yeah,
but my client's money is not emotional to me. Only my own money is emotional to me.
Well, yes, which is why, to tie this all together, you you started buckets all those years ago.
Absolutely, for everybody.
That's the goal,
including me, by the way.
That's
including
true,
me, because I worry about this every day.
Oh yeah,
with bucket strategy, finally.
You had more hair years ago.
I did.
And maybe all those years of worrying about it. That's right. Exactly. Joe Accardi, thank you so much. I really appreciate this.
Oh, thank you guys so much. I enjoyed it very much.
We'll have to fly you in again, maybe have you on every few months and
I look
get a
forward to
buckets
this.
update. I hope the next time that we talk that the markets are doing better and we could talk a little bit more about what to do, how a bucket strategy, how you would formulate a strategy for somebody when the markets are going up, because that's always kind of a fun
That's a great topic.
Well.
I'd be happy to help.
It is. Joe Accardi, he is the founder and chairman, if I said that properly,
You did.
of the Accardi Financial Group based in
Wilbraham, Massachusetts.
Wilbraham.
The home of Friendly's Ice Cream.
I'll just say the place, if
you must be getting sponsored by them. I hope they're going to bring over a couple of gallons when you get back.
Well, unfortunately, we eat more than a couple of gallons.
Well, there you go. There you go. And my thanks as well to Professor Rick Plum. If you want to subscribe to this podcast, of course, Spotify, you can get every episode, and don't miss an episode. We've got more great stuff. We'll have more great guests coming up here in the next couple of episodes as well. You want to get in touch with Professor Plum or any of the Lucia Capital Group people, 800-644-1150, or go to luciacap.com. luciacap.com, luciacap.com. For my good guest, my wonderful guest, Joe Accardi, and Professor Rick Plum, certified financial planner, professional. I'm Johnny Dean. I thank you for listening. This has been Managing Your Financial Future. We will talk to you, of course, again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material contains tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall. Financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Rick Plum and Joe Accardi are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the respective names Lucia Capital Group and Accardi Financial Group, which are separate entities from LPL Financial. Any individuals or companies discussed in this podcast are not affiliated with Lucia Capital or LPL Financial.